Hello and welcome to our Forex and crypto trading for beginners course. In this video, we will cover trend continuation and reversal chart patterns. And the last video, we covered candlestick patterns, market trends, support and resistance structures. If you haven't watched this last video yet, make sure to watch that video first. I've left the link in my description. If you do not have a Forex or crypto account, make sure to sign up on Binance or Deriv using the links in our description. And make sure to watch the previous videos on how to set up your accounts. I've also left the links in my description. Alright, so first, let's look at continuation chart patterns. These chart patterns are chart patterns that form in a continuous market, and they will help you confirm the continuation in the trend. Alright, so the first continuation chart pattern that you want to look into is the ascending triangle. This ascending triangle can be found in a bullish market. If you draw support and resistance trend lines and you see it forming a triangle like this one, it's an ascending triangle. You can see the price movement seems to be trapped within the triangle, but then it breaks out. In the second picture, you see that when the price breaks out of this triangle, it may retrace back and test the newly formed support line and bounce back upwards. Most traders like to wait for this retracement, and when it retests successfully, they place a trade. The reason being, it's a safer confirmation of the price continuation in the upwards direction. Now, let's look at a descending triangle. A descending triangle usually forms in a bearish market when the market is going down, and in a certain area, if you try to draw your support and resistance lines, when they form a triangle shape like the one you're seeing in this image, it's called a descending triangle. So as you can see, a bearish triangle is a support and a bearish trend line. A safer way to trade this descending triangle is shown in the bottom image, where most traders would like to wait for the price to retrace back once it is broken out of that triangle. This retracement retests the broken support as a newly formed resistance, and when the resistance is confirmed, the traders would like to place a trade. What if you try to draw a bearish channel in a bullish trend? If the trend lines form a bearish channel like you are seeing in this image, it's a bullish flag. And most traders want to trade this bullish flag if the price traces back to the last broken resistance and confirms it as a new support, as shown in the image below. Contrary to the bullish flag, if you try to draw a bullish channel in a bearish trend, you often in some intervals come up with this shape that you're seeing on your screen. You can scalp along the resistance by placing your sales, but most traders would like to wait for it to retrace back to the previous support. Once the price breaks out of this channel, this confirms the broken support as a newly formed resistance, and it confirms a continuation of the trend in the bearish direction. Similar to the falling triangle, but this time all the support and resistance lines are being drawn as trend lines at an angle. In most uptrends, if you try to use such trend lines and come up with that shape, it's called a falling wedge. A safer way of trading this falling wedge is shown in the bottom picture. Just like in all the previous shape that we have discussed, you have to wait for the price to retrace back to the previously broken resistance, and if the price bounces back and confirms it as a new support, then it will indicate that your trend is most likely to continue in the bullish direction. You commonly encounter a rising wedge in a bearish trend. When you try to use your trend lines and come up with a wedge shape, it's a rising wedge. And the safest way to trade this rising wedge is to wait for the price to break out of the wedge. And when the price breaks out of the wedge, you might want to wait for it to retrace back to the previously broken support and confirm it as a new resistance. This will confirm the continuation of the market price movement in the bearish direction. Then a symmetrical triangle can be found in both bullish or bearish trends. In a bullish trend, the safest way you wanna trade this one is to wait for the retracement, just like in all other previous examples. If you use inclined trend lines like this one and come up with an almost equilateral triangular shape, it's a symmetrical triangle pattern. So if you wait for this triangle to finish setting up, you realize the price may escape or break out of this triangle. For you to confirm it's a true breakout, you have to wait for a retracement. And if the price retraces back or goes back to the previously broken resistance and confirms it as a new support, then the price movement in the continuous bullish direction will be confirmed. In a bearish market, if you see such a symmetrical triangle, it will help you confirm the continuation of that trend when you see a retracement. And if the previously broken support is confirmed as a new resistance, then it confirms the price movement in the bearish direction. Alright, so what we're trying to do here is trying to trade in the direction of the trend. We are not trying to trade against the trend. So another handy concept that you might want to learn are the reversal chart patterns. Now let's look into the reversal chart patterns one after the other. First, we have a head and shoulders pattern. A head and shoulders pattern appear usually at the end of an uptrend. This is when the market forms a higher high after the previous higher high, then forms a higher low. And when you try to use your support and resistance lines, you find out that the lines will almost form two shoulder-like figures. And if you draw a line across the two tested support zones, you realize that it forms a neckline. In a reversal, the price will break out of this neckline going in the bearish downwards direction. And the safest way to trade this head and shoulders pattern is to wait for the retracement. If the price moves back to the previously broken support and confirms it as a newly formed resistance, then this confirms the price reversal into a bearish trend. A similar pattern may form, but this time in a downtrend. At the end of a downtrend, when the market forms a lower low after the last lower low and then forms a lower high, and if you try to draw a support line and come up with a similar shape to this head and shoulder figure, the chart pattern is called an inverted head and shoulders. If you draw a resistance line across the two tested resistance zones, you realize that this will form a neckline on the figure. And likewise, the safest way to trade these inverted head and shoulders is to wait for the price to retrace back to the formerly broken neckline and retest it as a new support. And this will confirm the price reversal from the downtrend into an uptrend. Similar to the falling wedge in the continuation chart patterns, but this time around as a reversal chart pattern, you notice that if you try to use your trend lines and draw your support and resistance and come up with this shape in a downtrend, you may notice the price may start breaking out of the falling wedge or this wedge shape that you are forming with your trend lines. If the price retraces back to the broken resistance and confirms it as a newly formed support, then this confirms a reversal in the bullish direction. So likewise, the safest way to place a trade here is to wait for the retracement. Another pattern that's almost sideways is a bearish rectangle. The bearish rectangle or the triple tops is commonly found in both bullish or bearish markets. In a bullish market, it will form triple tops which are almost in a horizontal line. And when you notice these forming and try to draw a support and resistance, you may wait a bit and try to notice if the price will break out of this horizontal channel. If the price breaks out of this channel, the safest way to confirm a reversal is to wait for the retracement. If the previously broken support is tested again and confirmed as a new resistance, then this confirms the price reversal into the downwards direction, into a bearish trend. In a bearish market, the price movement will form triple bottoms, and if you try to draw a line connecting these triple bottoms, it will almost be a horizontal line. And if you try to connect the double tops, you realize when the price breaks out of this newly formed channel, we have a potential reversal in the trend direction. But as usual, the safest way to confirm this trend reversal is to wait for the retracement. And when the previously broken resistance is confirmed as a new support, then it's safer to conclude that this trend is going through a reversal into a bullish trend. A similar pattern which also occurs in both bearish and bullish market, except it only forms either double tops or double bottoms, is called the double top or the double bottom. Alright, so let's look into the double bottom. When the bearish market stops forming lower lows and forms a low which is almost in the horizontal line as the last low, we form what we call a double bottom. And when you plot a horizontal line on the previous lower high, you form a neckline. And when the price breaks out of this neckline, usually this indicates a potential reversal. But to confirm the potential reversal, you have to wait for a retracement. If the price moves back to the neckline and confirms it as a newly formed support, then the price reversal in the bullish direction is confirmed. A similar pattern, but this time at the end of an uptrend, forms two tops in a horizontal line, and this is known as a double top. And when you plot a resistance line on the two double tops and a resistance line on the last higher low, if the price breaks out of the newly formed channel, then this shows a potential reversal in the market direction. And if you wait for a retracement, this will confirm the reversal in the market direction. Alright, so that's how you interpret the continuous and the reversal chart patterns. In the next video, we are going to look into how these patterns actually look in real world markets on the actual charts. Alright, so if you've reached this section of this video, I'll be happy to share with you this trading cheat sheet that I've been using to create this video. So make sure to check the link in my description to request this trading cheat sheet. Until next time, see you in the next episode.